Welcome once more to the final session of the first series. So we've had 3 sessions on endowment funds so far, and now we'll be having the last one for the first series. And going forward, we'll be keeping you updated on the other products we might be offering. So allow me to just indicate that KCDF is undertaking these trainings as part of the wider East Africa Financial Resilience Resource Hub, which is composed of the Foundation for Civil Society, Tanzania, and Civil South Africa, based in Uganda. So the aim of the trainings is just to support different organizations, see how best they can enhance their resources through diversification of the same. So you could be relying entirely on raising resources from donors, but you realize increasingly those resources are reducing. So we need to see how best we can also explore alternative routes, and this could be endowment funds. So today we have our partner, Enwealth. So Gloria can just give a brief overview of the same, and then afterwards we can invite our consultant, Joel Warutere, to take us through this afternoon's training. Over to you, Gloria.
Thank you, Bwira. I'll take you briefly through who Endowment is and what we do. So our name, Endowment, stands for Enabling Wealth, and we seek to enable wealth to support people in ensuring that they have financial security. So our purpose is positive socio-economic transformation of lives through innovative financial solutions. Our vision is a lifetime of financial well-being and dignity. Our way, how we do that is through trust, innovation, fun network, and excellence. Our business model is building an ecosystem of shared value, and our brand promise is for a better tomorrow. So we offer 3 services, that is pensions, insurance, and investments. We have been in operation for the last 13 years. We have about 60 staff. We serve about 200 corporates, and we also serve about 80,000 clients, and we are present in Kenya, Uganda, and Mauritius. Our products, we have the Endowment Capital Unit Trust Scheme. In it, we have the money market, the balance fund, the equity fund, and also the dollar money market fund and fixed income fund. So our money market rate as at 16th of April, that was 16.6%. And our board is led by Mr. Peter Wayaki, and our MD and CEO is Mr. Simon Wafubwa, and some of our board members include Sharon Kisire, who is a commissioner also at the Teachers Service Commission, Kennedy Monyoncho, who is a commissioner at the Salaries Remuneration Commission, and also Elizabeth Chengo and John Kilonzo. So that's briefly about Endowment, and I wish to thank KCDF for this opportunity to partner in this training. And right now, I'd like to introduce one of our financial investment consultants, that is Mr. Joel Warutere, who will take us through the risk management of endowment funds. Karibu sana, Joel. You can proceed to share your slides.
So today, I just want us to talk about understanding risk factors associated with endowment funds, the strategies for mitigating and maximizing returns, and practical examples of portfolio diversification as applied to risk management. I want us to start with understanding risk factors associated with endowment funds, and I want to define risk to start with on 2 levels. Remember, an endowment fund is equivalent to a collective fund where people put money in, that money is invested, and the income coming from that is what is used to run the objective of the sponsor of the endowment fund. So the risks normally come at 3 levels. There is a market risk, that is associated with the environment in which that endowment fund is working in. There is a portfolio risk or the investment risk that comes with that endowment fund, wherever that endowment fund is investing its funds. And the last one is agency risk. And this comes from the decisions that the people who are running the endowment fund make in relation to running of that fund. Who do you choose as your service providers? All this manner of things. Now, I want to explain to everyone here that my style and way of presenting means I'm a bit selfish. I don't like sharing your attention with the screen. There are details in here that you can that will be shared with you to read in later. But I wanted to speak through these three main topics. And let me start with first. Generally the risks that are associated with endowment funds. And the first one that I had mentioned is the operating environment, and this can come in two factors. One is that you have to remember that you're operating in an environment that could be affected by many other factors, economic, social factors that dissuade people from participating in the endowment fund. And the biggest aspect about that endowment fund is the source of funding. Is the source of funding, and that source of funding comes from the various contributors to that endowment fund, and also the use of the funds. Because if the people putting the money in do not see the benefits, then that becomes an issue. So there are two responsibilities that come in here. So in terms of the operating environment, if it is not ideal, then this does not sit in very well. We in Africa have not been very, very successful in having, many endowment funds running across board. But if you look at the US market, one of the biggest factors, aside from the pension sector, one of the biggest, one of the biggest mediums through which savings are put together is also through endowment funds. And some of the biggest social impacts that you find in such markets is also through the same endowment funds. And I like pointing out to one of the most famous ones, the Harvard University Endowment Fund that has been running for ages, the Yale one, the Princeton. So you will find, I like pointing those out because then they are related to what we are doing today, learning and empowering ourselves and building a bit of capacity. So on one level, risk is, when we talk about endowment fund, risk is not delivering on the promise. That's one of the bigger risks that an endowment fund will face, where what was the reason why this fund was set up, and are we meeting that objective? And that now is related to things like management, to things like the operating environment, the source of the funds, the deployment of the funds, the return on investment now brings us to the second level of risk. And that is the financial risk. And that financial risk now has nothing to do with operations. It has a lot more to do with managing the exposure of these funds as far as what they're invested in. So the second risk of financial loss is the exposure to that you may lose these funds as you invest them. And this is where now we start looking at all other factors in terms of, and these are things we look at as we move along. What are the risks that are associated with them running this endowment fund and it creating a value? When we look at the general factors, and this now I'll focus more on agency, a bit of agency risk. This is one of the bigger risks and market risk. Agency risk means that the decisions that are made by the management, the trustees of the endowment fund, in terms of the people they hire to run their functionalities, the people they hire to market and publicize this fund, who then have to reflect the values of that fund, is one of the factors that will be related to the CSAs who have joined this call. In the sense that this fund surviving and operating and being successful is also reliant with how you present yourselves, showing the culture and the value system of the fund that you represent. And this, in this instance, is KCDF. And this is what helps you create the largest impact in the sense that you're able to reach more people, you're relatable, and more people are able to relate to you. And you're also able to then share the culture of what you're trying to change or impact socially. So as far as agency is concerned, please consider that when we talk about agency in terms of who represents the fund, I'm talking about then people, the CSAs who then are working on behalf of the fund. How effective you are is all factored in the essence that you're able to reach these people and these people listen to you. Which brings me to two key factors that I'll talk about shortly: discipline and efficiency in what you do and how you do it. The other bit is the service providers who then work with the fund and work with KCDF to be able to expand, to offer services that are related. In this case, like the partnership that KCDF has with NWELL means that NWELL, how NWELL represents or serves the members or the participants or the beneficiaries of KCDF also matters. So those are things, those are on a higher scale, those are things that you look at. In terms of then looking at, again, another agency aspect, the management, the publicity, the effectiveness, would I say the transparency in saying that this fund is set up and is structured to serve a particular purpose. And the same way it comes upstream is the same way it will go downstream. So that's why it is important for you as participants here to understand that one of the biggest risks, even before we go to return of the investments, one of the biggest risks comes from the agency factor. Those people who represent the fund and the endowment fund itself. Not only from the funding side, but also from the participation side, and also from the beneficiaries too. And also seeing that the vision and the mission of this fund that is linked to the endowment fund is actually affected, all runs down to you guys. So it is important to bear that in effect, that even as we are going to more interesting things like, return on investments, managing risk, the risk factors, it is important for us to understand that you are entrusted with the responsibility of ensuring this endowment fund works. So I want to, there's a small bit there that I want to, I always put it up there to make people understand that social security is an important factor. Social financial security and planning for retirement is something to think of. So things like, are you planning for retirement? It is something that you can answer later when you get this presentation. So I wanted to talk about then the part of the investment risk and the whole overall risk of running an endowment fund. And two of the key factors that I look at is investing in investment, in running any fund that is related. And I want to remind you is that, remember that an endowment fund is a collective vehicle that brings together funds to attain a certain objective that serves the many. And those who are needy, those who need support. That's why I was using the Harvard endowment funds or Yale or Princeton, because those have been used for years and years to provide scholarships for students who are in need. So I want to come back to the aspect of agency and why discipline is important. Then you know this vehicle, which is an endowment fund, then will run on a set of rules and regulations, which are set by either yourselves or the trustees or those entrusted to run this endowment fund. And that includes the key aspect about discipline. And I like the quote that Warren Buffett puts there. You don't have to be smarter than the rest, but we have to be disciplined, which in turn allows us to succeed or even outperform those who think they are smart. So enforcing the rules and regulations, keeping timelines, staying faithful to the process that you set out. And this is where I was talking about culture. Being able to project the culture of the fund and the objective and the vision that you're trying to achieve is important. Taking hard decisions when they need to be made and having a long-term investment policy for the long-term asset allocation. Now that will come in the part of risk management and risk mitigation. To be able to do that, then you have to focus on efficiency. And this is where the bit I say that you have to take into consideration that you're not wasting time and you're not wasting effort. Because then if you're not efficient, it means that there are missed opportunities, there are missed chances, there are missed timelines, and that affects the delivery of the vision that you have. So it is important that you take time to plan yourself. It is important that you take time to capacity build, as we are doing today. And it is important, and that's why I always say measure twice, cut once. It is easy to implement when you've done the planning. So it is important for us to remember, for us to be effective, we have to be disciplined and we have to be efficient. And you'll allow me, for those who may not be of the faith, I always say it is important to remember, even the Bible tells you that, you aim to be not only productive, but also to be fruitful. And this is what brings this together. Now, I wanted to look at it from this perspective in terms of then how do we mitigate against some of those risks that we face when dealing with endowment funds? And you have to look at it from the two ends. You have two groups of people, the people who carry the vision and the people who implement the vision. The people who carry the vision are the people who are saying, this is what we want to achieve. The people who implement the vision are the ones who say, we are paid to do this. Simply put. So the strategy and the supervision of that vision is set by the people who are carrying that vision to ensure that once you take on someone, once you engage someone to run a certain responsibility, then that person, then you have to supervise them to make sure they're doing what you set out to do. And that's why you always find that there are those two levels. And this is one of the two, separating these two is one of the best ways to actually mitigate against some of the risks that come from the agency front, where there are people who are acting on your behalf. Then we'll look at some of the other factors, but some of the things that you look at then when vetting and managing risks associated with investment. Because remember, the endowment fund provides a platform where people can put money to achieve a certain purpose. It could be social, it could be financial. So the people who put in that money are expecting that once that money is put, it will be invested properly to generate a return, and it is that income that is then used to achieve the goal. So an endowment fund comes with the sustainability aspect. It is sustainable, it can run for generations and generations. That's why you find there are endowment funds that are even 100 years old. And they've just been running, as they may not get as many depositors, but they never run out of people who are beneficiaries. So I normally say, when also looking at investments, then you look at things that you vet, things like what regulation is there to support where we are investing, what structures are available to allow us to be able to operate efficiently, what support pillars are we dealing with, is there demand for whatever we are investing in, what are the governance structures like, and most importantly then, what professional advice and feasibility study or due diligence has been done before that investment is made. And these cuts across board. This cuts across board.
Joel, you can proceed. It can happen concurrently.
Sawa. This
Okay.
cuts across board all aspects of investing. And that's why I always tell people then be careful when you're making investments to answer these questions, because in case of anything going wrong, then you're relying on the governance structure to say to support you. In case anything goes wrong, you're relying on regulations that help you get some level of justice in relation to anything that has not worked for you. So then the feasibility and due diligence gives you information you know and supports your decision making. So I normally at this point tell people that, one, you have to remember that all these aspects we are talking about give you information. They give you information, and this information allows you to make the right decision. So I always say money changes hands from people without information to people with information. So you always ask yourself, how much information about the investment that I'm making do I have? How much structure am I aware of existence? How many laws support what you're doing? How much regulation? How much am I seeing support structures in form of governance? Are these people who are running well? And I normally say, examples, you'll be able to tell whether people are knowledgeable, whether they're empowered, to be able to know that they understand the product that they are running. So it's always important then to have the information first, then make the decision afterwards. And that's why you find I have put those 7 factors there. The governance structure, the feasibility studies, in terms of what regulation is there supporting. And I'd like to, give just a basic example, because I want to combine agenda 1 and 3. For the longest time, you find, people have always talked about, the agriculture sector, which is the biggest sector in our economy. And there is a potato value chain. The potato value chain enabled investors coming to this market because it was able to map out what are the expectations, what is the value creation, what is the process, what is the quality assurance. And that's why I say there has to be structures and regulations. Let me give, the example of even the tea bill that came in that allowed that, farmers could market their own tea, but subject to certain quality standards. So the potato value chain allowed for the Germans and the Dutch to come and invest in the potato industry in Kenya. And that's why you found that the minute you found there are some end users who are using other potatoes from somewhere else to make fries, there was a lot of noise, which made a difference. If there was no one, if there was no structure, if there was no support, if there was no one to point out that and ask, where are these guys buying their potatoes from? Then who would have suffered? Our farmers, because there was no one to call attention. There was no one to call attention to the very fact to the very fact that other people are then importing potatoes while we are producing some here. The structure allowed the person who noticed that to be able to point to governance rules that say that, you know, if you're operating in Kenya, you should get your stuff from here. So that's why it's important to have all these factors in place. Again, when you look at then what other factors are considered when making decisions about investing? You know, we start from the top down. You say, if you're looking at getting into the agricultural sector, how does the agricultural sector feature in the economy? And that's what we call macroeconomic trends or thematic trends, where you're asking yourself, so what is the agricultural sector in relation to the whole Kenyan economy? Then you go down to the other factors. Are there markets? Are there support structures? All those aspects you're looking at is what we call shifts in fundamentals and technical indicators. Those are all technical items, but I don't want to get into that immediately. So the key considerations when you're looking at then how do you mitigate against risk? And please remember, you cannot eliminate risk at all. Risks will always exist. It is how you manage. It's how you manage those risks that reduces the level of exposure. So let's be very clear about that. Risk will always exist. It is how you manage those risks that matters. So what are your long-term plans? What supports your vision and mission? It is through long-term strategic planning and saying, where do we expect Kenya to be in 10 years? Where do we expect this county to be? What direction are they facing? What direction are they looking at? What are they looking to get to? Are they partners we can engage with? No. So having a long-term strategic plan in then essence allows you to also identify who are your strategic partners, who you're journeying with on the same road. Regulatory frameworks, I talked about laws existing. These laws allow you to get get sorted out or to get, would I say, justice when you need it, which means it reduces any risk of exposure to any malpractice. Infrastructural support, you cannot say you're going into an area you cannot reach. And this is where we talk about, may it be technology, may it be roads, may it be telecommunications, because you can imagine, we are having this forum across many people, and we didn't all have to travel and go to one place. And then the most other important factor that mitigates against loss, because, you know, let me give the example. You know, there are many people who run and say, oh, now it is important, it is time for us to go and invest in quails or in chicken, and they have not answered the question about access to market. Who are you going to sell to whatever you're making? So it's always important to manage risk, is not to wait for the risk to appear. It is to actually put structures in place that take away the chance that you may lose by making sure that all these structures support and limit your exposure. So I will always tell people that you have to look at your access to markets. You have to look at the regulatory frameworks to make sure that you get remedy where there has been malpractice, you've been ill-treated, you can recover something when you have lost it. And last but not least, then you're saying, what sort of advice have I sought? What kind of information have I garnered from people to allow me to be able to say I have sight, I have visibility of where I am going? And I normally say this is the equivalent that when it gets dark, when you're driving, you turn on your lights. Advice gives you illumination. Advice gives you information. Advice makes it better makes it easier to make a decision. Feasibility study and due diligence is also going down to the ground and saying, what kind of space am I going to invest in? What else don't I know? And feasibility study, I give you the best example because all of us know about buying land. Feasibility study means going to the ground and seeing, is a parcel of land I'm buying empty? Yes. Asking people around, do you know the owner? They can collaborate what the documents say. Then the due diligence is taking that documentation and taking it for a search to them to, like Ministry of Lands, where you confirm that the names are as titled. The documents of ownership reflect what the regulator or the Ministry of Lands will say, or the government. If you're planning to invest in it, then a feasibility study will help you because then you will decide, does it make sense to put a block of flats in the middle of a block of flats? Or does it make sense to put a restaurant in the middle of a block of flats? Because that block of flats, all these people have to eat. Do I put a laundry, instead of doing the same thing everyone else is doing, do I go look at that place, see that there are 5 blocks of flats, they don't have a laundromat, they don't have a pharmacy, they don't have a mini-mart, they don't have an eatery. So instead of building one yourself, then you say, I am going to provide services that serve all these guys. And that is the importance of a feasibility study. And that is why it comes in handy, because then it allows you to make the right decision that matches where you're making your investment. And this not only applies to institutions, and like now the endowment fund that we are looking at. It also applies to you individually. So I say, whatever you're looking at, even looking at now this endowment platform, will not only help you in terms of achieving what goal you're setting out, but it creates a platform that allows you to also learn individually, as we are doing today. The collective nature of an endowment fund is a reflection of exactly what we are doing today. Through one platform, KCDF, we are able to bring you all together to learn and build capacity, as opposed to me coming to each and every one of you and talking to you. So this speaks to the very fact that then we are achieving the goal of efficiency. And that's why I say it is important that these vehicles come in handy, because then it is through such a vehicle that you're able then to start looking at bigger goals and platforms than this. So I wanted to give examples of the regulatory framework of things we look at. The Constitution of Kenya, Kenya Vision 2030. And I'm saying when you want to invest in Kenya, then what are you looking at in terms of regulatory framework that will help you and guide you and support you and will support the value chains where you're putting your money? And those are some of the examples of the regulatory platforms, running all the way from the national level to the county level. And as you will notice, information is important. So I want us to get a bit technical now as we go towards the end. And the 3 risk categories faced by endowment funds, which are similar to even retirement benefit schemes, is the systemic risk, the portfolio risk, and I've talked at length about the agency risk, who you choose to work with you. Portfolio risk is where do you invest your money? And that's what we were just from talking about the structures you look at, the approach you look at. And please note, you never move from risk to return. You never move from return to risk. Because most of you, if today I was to carry out a poll here and ask you, if I brought an investment to you, what is the first question you'd ask? And for the sake of that we cannot now start, picking on every one of you, I'll give you the best examples. When someone brings an investment opportunity to you, one of the things you ask is, what is the return? And the next thing you ask is, who else? So because you you want to know how much you're making, and secondly, you're looking for comfort in numbers, so that when things go bad, you say, I was not alone. It's not only me who lost money, even Nani lost money. And those are the wrong questions to ask. Whenever you're considering an investment, you're first asking, how much risk am I taking? Secondly, can I afford to take the risk? And thirdly, is this risk in line with the money or the people I represent? So you should always move from risk to return. So you should always ask, what risk am I facing before you ask what return? And that's why you will notice I have not talked anything related to, the returns that an endowment fund should generate. Because I believe an endowment fund survives to posterity. It is made to last, which means safeguarding whatever funds you have is one of the first and most important objectives. So you fundraise, you safeguard the funds, you invest them properly. When you invest properly, then that income helps you achieve the goals that you set. And by using that income to achieve the goals that you set, it means that every year you'll be available to serve the purpose. So it is important then, as much as then we have sorted out the agency risk, we are sorting out the portfolio risk. And that allows us to be able to say that we have invested this and these funds we have been entrusted with in the right manner and in the right way to be able to allow us achieve our objective. So developing the structures, and I'll take you back, developing the structures that allow you. Remember, I said the roles are two, the strategic and supervisory, and then the second one is implementation. You don't worry so much about implementation if you have your strategy and your supervision right. And that's why you find, I can see the poll running there, the need to develop an endowment policy. That is important. And strategy, that is critical because that speaks to your vision. Supervision is now having the right governance structures to ensure that you are assuring yourself that your vision and your long-term strategy is met. So it is important. Then I'll just mention about systemic risk and the importance of understanding is this, so that you're able to differentiate between the three. The systematic risk is called market risk. This you can do nothing about. And I want us to understand that. Portfolio risk, agency risk, you can do everything you need to do about it. But systematic risk is market risk, election, flooding, you can have droughts. These are things you cannot do much about, but you can, to a certain level, safeguard yourself from the exposure. And systematic risk only comes into consideration here in as far as you're ensuring that the endowment risk continues operating. So in this sense, we are saying that you may reduce your effectiveness in fundraising if at all you're not able to use the funds, invest them properly, and generate reasonable level of income that allows you to attain your objectives. So I normally say it is important that you bear that into consideration. I've been given the responsibility of showing what is an example of portfolio management, how you set up an investment portfolio. Now, what I'm putting here, just to reflect on what I talked about, regulatory frameworks. This is contained in the regulations issued by the Retirement Benefits Authority, which is a guideline for pension schemes, which tells them that you're spreading your risk. Now, this is risk management as far as diversification is concerned in managing investments. So you put some little money in cash, you put some money in fixed deposits, you put some money in bonds, private bonds, you put some money in government securities, you can put some money in shares, you can put some money in property, you can put some money in offshore investments. So a portfolio is a collection of different investments in different investment vehicles that allow you to get a return that reduces exposure. Because you can imagine if you are invested in one area only that was affected by the rains that are happening now, what would happen? You'd be in trouble. That's why we call it diversification, where you're spreading your risk across different assets and investments. That way, you're not exposed to just one event. That's why we talk about a portfolio of investments as opposed to just one investment. So I wanted to use that as a showcase of, what kind of investments, how a portfolio would look like. Definitely, when you're putting one together for KCDF and for the endowment fund, it would reflect the risk. It would reflect the risk. There is one endowment fund that is run by Academy of African for African Sciences. I can't get the name right, but what they did is that they put up 500 million, and that 500 million has been invested continually into such assets that generate a return. The return generated from here is what has been used to support science fairs in Kenya and in Africa, to support budding opportunities or new opportunities that come from people who have come with innovations in the science field that need some level of support. So that is what you're looking at doing. And that maybe in a nutshell, these are some of the things that you look at when you're looking at what are the risks that you're having to mitigate and manage as far as such investments are concerned. Now, there's a bit more information, but I also believe it doesn't help if we overload you. Maybe I have given you something enough for you to go think about or contemplate. And I don't know, Buire, whether it is there was time allocated for questions, or I can leave the next 10 minutes for anyone with questions, or maybe any questions that have been raised that I can answer.
Yes, so we have time devoted for the questions, and it could start from now. So if you have a question, you can type it in the chat or just raise your hand, and we'll be able to unmute your mic for you to ask your question or share any concerns that you may have. So Joel, have you concluded the presentation?
Yes, I was actually leaving room for questions.
Okay.
Yeah. Or even any clarification, I'm easy. I've seen Mary Porfia had raised her hand to ask a question.
Hello, my name is Mary Apofia, and I'm a freelance grant writer. So first of all, thank you so much for extending the training to a wide base of participants. So my understanding of the endowment fund is that it seems like a great sustainability plan, especially for small organizations and startups. But you find that with small organizations and startups, the trustees or the advisory is the same one as the implementers. Like they're one and the same person. So, and based on the presentation, it sounds like separating the two helps in reducing the risks. So what is your advice for the small organizations and the social enterprises? Do they wait until they have enough capacity to separate the roles? Also, I found that the endowment fund looks like in the beginning, you need a certain capital to start it. For instance, in developing the policies and also hiring maybe the funds manager. So for startups and small organizations, they might not have the capacity in the beginning. So would you advise them to wait until they have this capacity? Or is there a simpler model that they can start with to get into the endowment fund? Yes, that is my question.
Okay. I've also seen something from Joy for me to repeat the separation between strategic and supervisory. I'll do that, but let me first answer. Let me first answer the first one as to capacity. Capacity can be created in one or two ways. Capacity is created by either collectively or, by having capacity, being individually having the ability. So at times I say it is better to look for other small organizations who have purpose and vision as you do, and you do that collectively. And I believe that is why KCDF is there, to create a platform that allows these smaller institutions to be able to stand together. So I say at times also, you remember my discipline and efficiency analogy? The efficiency then is a big factor, because then if you wait too long, then there's a time value that you're losing. So I normally say then in that case, then let's then find a platform that brings us the collective capability of bringing or pulling together resources to give us the capacity that we are looking for. Because yes, I agree, the endowment fund should not be a small vehicle, because you're looking for volume to be able to generate enough income to have an impact. So I say at times then look for like-minded institutions as yourselves, or look for a platform as such that is offered by what KCDF is offering, which allows you then in turn to get the capacity you're looking for, or to get the scale that you're looking for. So that's why I say this is important. And I was saying today we've achieved being able to reach 80-something people under one platform. So reflect on it is the same way then an endowment fund would work, because then you have a platform that brings the like-mindedness together. In terms of trustees, this now talks to governance structures. And as much as you may have trustees at the very top, then you've got the community participants or service officials or activists at the ground who serve as the representatives. So there is a way to be able to keep the link working and to keep the effectiveness running. So I would say, yes, the governance may not cost as much as we think if we are efficient. So I'll also just respond to a question that had been asked. You know, what's the difference between strategic and supervisory? The strategy speaks to vision. Strategy speaks to vision. Supervision is where you put policies and processes and structures in place to ensure that you have achieved your strategy. So you create a long-term strategy where you're saying, like Vision 2030. Vision 2030 was created. Then the Vision 2030 Secretariat was created. So you have the strategy and then you have the ability to supervise the strategy. That is one end. Those are the vision carriers of what you want to achieve. The implementation are the people who are paid to implement that strategy for you. And then now you're tooling things like reports to be able to police or to supervise the performance of the people implementing. So that's a difference between the strategic planning and supervision. I hope that answers your question effectively. Any other questions? I had seen a hand raised by James Gitari.
Sorry, I was speaking while on mute. So James, kindly unmute yourself and ask your question. Afterwards, we can move to Florence and then Rawlings and Jackson.
Thank you. Thank you so much. Let me begin by appreciating KCDF for giving us such a wonderful platform. For me, this is the first time I'm getting into the knowledge matter of Endowment Fund. And I'm from Africom Development Center based in the Rakanithi County. I would want probably maybe to ask more or less what my colleague has already asked, because we are a small organization, we are a community-based organization. And one of the critical areas where we find ourselves having some weaknesses is especially on capacity, human resource capacity and financial capacity. When I look at the aspect of endowment fund, like she has already said, it seems like then we may need some specific capital for us to start. And so I need your guidance or advice because we do have some income generating activities, which we give through our consultancy, especially on corporate training and peak performance training. So for these income generating activities, can they be grown eventually to become endowment funds? And since sometimes we do not pay taxes on these income generating activities, why would it be okay if we just grow them as income generating activities, even if they give us some cash in? Or why would it be important for us to make them become endowment funds, yet they are already serving the purpose that we need? Kindly.
We'll be able to put that in reporting.
Okay.
And also there are risks in terms of
there was Lawrence.
Of compliance, because if you have community of banks together with other donors,
Hi, Joel. Would you like to take that one, or we proceed to the remaining ones, and then you check them at once?
Let me respond to that one quickly. Yes, I do understand, and I want to appreciate what James has said. Whatever you're doing at the level you're doing, it still works. And I like the fact that you've talked about being also a faith-based having a faith-based angle. So the question I always ask is this: if what you're doing works, and if what you're doing serves, and if what you're doing is of value, wouldn't you want it to reach more people? And if the answer is you'd want it to reach more people, then that means it requires a certain level of investment. So simply put, rather than it looking like something from the blue, an endowment fund is just a vehicle that helps you pull resources into a platform that allows it for it to be more effective and for it to have a wider reach and for it to be more productive. And remember what I have just said. I draw a bit of what I was talking about from the Bible. It is not just enough to be productive, which is what James is saying they are good at right now, but it is also important to be fruitful, which means whatever you're doing it and doing it well, we want to spread it to others, you want it to reach to others, you want it to reach to more people, and the more productive it is, the more fruitful it is, the more resourceful it is for the fund. So look at this fund as a platform that allows you to also take the same resources, package them, and say, we think we can offer this service to more people. Please invest in us. So don't only look outward and look at other things that are out there. Also say that we are also developing value that is enough for us to qualify to be a candidate for investment, for us to be able to expand our reach. So an endowment fund just expands your capability. It expands your resource reach, and it also expands your ability to actually do more. So it is more of a tool than it is an end destination. So that's why I say, if you look at some of the more developed institutions globally, you will always find that the ability to harness savings or funds into one pool to be able to do more effectively has always been a way to go. There was another question from Lawrence, and then I think Jackson.
So
I think the last.
Flores, kindly unmute yourself and ask your question. Hi, Florence, are you still there? Kindly unmute and speak.
Yes. Can you hear me now?
Yes, please.
Okay, thank you so much, Bire, and previous speaker. Well, just finding out whether it is important that an organization, established organization who has a strategic plan can incorporate a clause as a fundraising strategy of having an investment that will support the needs of the organizations. That is for the work that organization or supporting the achievement of the organizational strategic vision. Is it okay that we highlight it in the overall organizational strategy, or we keep it into that independent document for the trust for endowment fund? I just wanted to know how that can be of good importance in terms of lobbying and advocacy for more funding. Thank you.
If I get you right, is then being able to put into your strategic planning or clauses that allow you to invest within the organization. Do I have that right? Florence? Let me see if I have this right. The key aspect about ensuring that then your your endowment fund or your investment strategy then survives to posterity is also the separation of roles.
That is what I meant. That's what I meant.
Yes.
Thank you.
As much as it would be nice for you, even as you're fundraising, you're saying you're able to invest, make investments within directly into your channels is one way, but also having this endowment fund, you can do that. As you're fundraising, it is okay to put a clause there where you're saying, as much as we are fundraising to achieve a certain objective, as a social organization or community organization, you can also have a clause there that says, at the same time, for sustainability, we can take some of those funds and put them in investments that help us continue operating into the future once we build up enough mass, which is the very definition of an endowment fund. But remember, then the endowment fund will be run by a board of trustees who are separate from the management. That's the only bit I wanted to point out in terms of governance. But yes, it is possible, and you normally say it's a way to go. That way, then you're creating a pool that will continue to exist, and that will get you to a point where you don't need to rely on external funding, because this pool is actually generating enough income to support your activities. I hope that answers your question.
Thank you. So we can take a question from Rowling and Jackson and Michael, and then the rest can type them in the chat. We can respond later via email. At Rowling, kindly unmute yourself and ask your question. Hi, Rawlings. You unmuted, kindly speak. So since we can't hear Rowling, let's just move to Jackson. Jackson, kindly unmute and speak.
Okay, thank you very much, Buire, for this opportunity. Thank you also for the presenter. I have two questions. One, I wanted to know, in a scenario where the fund manager, the agency, if it collapses, what happens with the endowment funds? I know you have talked about the systematic risks, the portfolio risk, and the agency risk. The first two are actually very elaborative. My concern is on the last one. In case it collapses, are they insured by the relevant government authorities, or what happens? The second question is on the money market. When I look at the diversification of investments, is money market part of endowment, or what is the difference between money market and the endowment fund? Thank you.
Okay. When your service provider collapses, the way the structures that the endowment fund will be getting into would be set up, will be in such a way that there would be a custodian who holds the assets, such that if the fund manager collapses, then you're able to continue operating. If there is any negligence, the laws allows for the trustees of the endowment fund to sue for remedy, to recover any losses incurred from the service provider. But as far as the assets, the savings, the funds that are put in the endowment fund, those are safe from the collapse of the service provider, and in this case, of the investment manager or fund manager of the fund. because then they are separate from the operations of the business itself. And that normally is the structure that is normally recommended. You have a custodian bank that stores the assets, then all the other service providers just issue instructions where necessary. As relates to money market funds, those are collective investment schemes that are commercial in nature. They are profit-making, return-making, which are different from endowment funds, which tend to have more of a social aspect. In this case, when you're talking about KCDL. But endowment funds exist for a purpose specifically. Money market funds exist for being able to achieve an investment objective with a liquid leaning, where you're saying, I don't want my money to be tied into long-term assets. I want it to be tied into short-term assets so that when I need it, I can get it. That is what a money market fund is. I hope that answers your question, Jackson.
Hi, Michael. Kindly unmute
Hello.
yourself and ask a question. Yes?
Am I there?
Yes, we can hear you. Please proceed.
Endowment, money markets versus small entities like us in Uganda. When I see this chart is shared by our brother, category of assets and all that, I see imperialism in the. What are we speaking simply for a struggling agency to make money? I think the argument should be starting small in order to grow big. Because when I see this chart, which is still on the, I'm threatened by things I don't understand. I have money that somebody has entrusted me. What should I do to cause that money to multiply? My concept is now being limited to entrepreneurship. That endowment is the money being how enterprising can somebody be with the little that you have, with the little you have, because all those other things you are putting there are for guys who speak money, investors, I don't know what, and then so I don't know whether you can rate these NGOs to be in the category of investors. Okay, they can reach that level, but what we are trying to do is, how can we multiply the two coins? If I use the biblical language, how can we have something small and put yeast into it and make it to multiply? That is the issue that I think should be reinforced. Then later on, when we are stable, because right now, civil society agencies and NGOs, they cannot compete. You see, you compete with the Chinese, I don't know what, all this investment, I think it will not take us far. I appreciate your drive to give us a financial eye, financial eye into this entrepreneurship docket. But I think the consultation should be, you have 1 million Uganda shillings. What will it take you to put it somewhere so that it brings you more money, instead of keeping it there and it doesn't bring you 1 or 2 coins? I thank you.
Jackson, or Michael, thank you. Thank you for being honest. And I like that, because I'll take you to the Bible again, because, you know, the Bible says my people perish because of lack of knowledge. And that's why we are here today. We are here today, Michael, to take away that small-mindedness that you have, where you fear, because you think your money is not important because it is small. But without that 1 million, you cannot buy a vehicle of 10 million. So please start by respecting the little you have. And when you take it seriously, then you can also start looking for people who are equally as serious as you are. That is why you hear that big word endowment being thrown around. It's just saying that we are creating a platform that allows your 1 million, someone else's 500,000, another person's 10 million, another even person 10,000, to come together, to create a pool that can now do more. But if you start disrespecting your 1 million from the word go, you will lose it because you're not taking it seriously. That 1 million is important because it, as part of a group, it forms a part of a fund. And that fund now can be taken seriously. You start looking and participating in this important, important conversation. So let's look at it this way. And that's why you find I talked about discipline and effective and efficiency. Is that whatever little money you have, individually it may not mean much, but collectively, under a platform that is well structured, it can make a very big difference. After all, everything grows from a seed, doesn't it?
Yes.
So it is from small to big. So I would say,
yes,
let us invest in our vision of looking for like-minded, like this platform has given me, like-mindedness, where you're saying, it is my 1 million, Michael, it is important, and it is not to be taken for granted, and I'm putting it here only to allow it to achieve more than it can achieve individually. Then knowledge
Yes.
sharing. This platform allows you to share knowledge, to compare notes, to learn from others without having to pay for it, because the same person in the same platform will be more willing to talk to you and say, we're on the same journey. Here is something as a helping hand. So Michael, don't lose hope on your 1 million. But think about
that is the language I would like you to speak. A language that pulls hearts and minds to say, yes, we can move on and we can try with the little that we have. I think so.
But I have to bully you a bit so that you can ask such questions. That way that then we can answer them. And that's why I'm happy. You've actually just made my afternoon. By asking that question that way simply then allows me to know exactly what then we address, so that even the information we get from here on allows us to actually address you. But we had to start from somewhere, didn't we?
We have started then.
Yes, thank you.
You're welcome.
So we can hear from Tracy Nyenze. Tracy, please unmute yourself and proceed.
Okay. Yeah, just confirm that. And then secondly,
Tracy, unmute.
Sorry, I had unmuted. Thank you, Mr. Bray, and thank you, Joel, for the presentation. I just wanted to reiterate on the question that was raised by Michael. I guess if I hear him right, the question is, where do we start? It is breaking down this information to a non-financial person. I think that clarity needed to be there. Personally, I might understand some of these things because I have a background in finance, but what about people who have that 1 million like Michael has? He does not know where he can start with it. And I think it is that basic knowledge that people would be looking at. Thank you.
Thank you, I agree. And as we said, we have to start from somewhere. And what I'm very, very grateful for is that KCDF is here now. This is a platform, and also the East African Forum is a platform that can start us addressing such issues. And I believe that you will start getting more information that is broken down further into simpler body of knowledge that allows you to also reach those who may not have any financial background. That is available. And the good thing is that this will not stop now. I believe we'll continue sharing more as we get more feedback. And that's why you found I appreciate when I'm asked questions, because that allows me to know what to address as we continue. So there's a lot more to be done. There's a lot more information to be shared. And we'll continue doing that as we go along the journey, because I think it is critical that then you're bringing everyone up with you together. More financial information, more valuable information helps better decisions, even at the very basic grassroots level. So I do agree it is important that we also start creating content that is more simpler, as Michael also pointed out. But as I said, that is well taken and really, really appreciated.
Right. So thank you, Joel. Thank you, participants. Now we've come to a conclusive end. So if there is any burning question, we've had that our facilitator appreciate questions. So kindly, I'm giving a slot to 1 or 2 people. So James, I can see your hand up. Kindly unmute yourself and ask your question.
Thank you very much, and thank you for this opportunity for giving us knowledge about the Endowment Fund. I will kindly request if you can probably in future sessions, or if the facilitator can address this and explain if the Endowment Fund is Sharia compliant. Some of our organizations have some religious affiliation, and in the Islam law, we are not allowed to get interest out of investments or such things, or interest out of loans. So if you can either be explaining this session or future sessions, is the Endowment Fund Sharia compliant? Thank you.
James, thank you. There are two sides, and there are two platforms, and I'm happy to say that lately regulation has been paying attention to the Sharia side of things, and there's a lot being done to ensure that both platforms are available. That serves those who are okay with this other more capitalistic approach, and also to have the same that is Sharia compliant. And I'm happy to tell you the regulations that allow us to have and structure and set up that aspect of the endowment fund that allows the fund to be Sharia compliant. But unfortunately, and let me say this, let me be very honest, the two can't exist in one vehicle. But they can exist side by side. So it is possible to serve both the Sharia side and the other side.
So Linda, please unmute yourself and ask your question. Sorry, please unmute now.
Yes, good afternoon, everyone. Thank you so much for this opportunity, and thank you for giving us the knowledge and skill. It is still my first time to attend this kind of training session about endowment fund. I really wanted to understand, and it's a request that since I come from the community-based organizations, I would request that in case if this kind of training can be organized again, so that like for us, the people who have been our first time to attend this kind of training, we get to know more about what is endowment fund. And since it is for East Africa, I would really want to know, now since I come from the community-based organization, if my organization wants to get the endowment fund, is there any link or anything like a proposal, okay, something that they give for you to write a proposal on about what you really want to invest on? That is really my question. And it is my first time. I really want to know the kind of criteria, the selection criteria you people you used that day when I got the email about attending this kind of training, because I was actually surprised about getting my mail to be part of the participants for this training. Thank you. I beg to submit.
There's a portion I think Buire will answer. The part I will answer is yes. When you're setting up such an endowment fund, it is you, as I said, you're the vision holder. It is you who also gets to do an asset allocation or propose how you'd want the funds invested. So you're given choice and you have choice. And since you're the one who's originating the documents in the strategic plan, then you're able to actually highlight the areas you're interested in seeing your investments go into.